What is going on, everybody? I'm Susu. Absolute pleasure having you. Thank you for showing up. All right, let's get right to it. So normally we talk about charting and stocks specifically, but today we got to talk about some fundamentals. We got to talk about the big picture, the macroeconomics of the world. And there's a couple things that boggled my mind over the last few days. One of them was this, and the reason why I like stories like this, because let's remember, when you're looking at a story that's from MarketWatch, a story that's from Zach Investment Research, and these company barons and stuff, they have a vested interest in you believing whatever it is they're going to say, because they want to manipulate you to require them, because they got market research, they got subscription services and newsletters and all this bull nonsense that you don't need. But it is useful. I'm not going to say it is useful. Some of them have fantastic research, but what I'm getting at is they have a conflict of interest in the way they're giving you news. This is NPR. NPR's like Fox or, CNN. They have their own thing, but realistically, they all want to be right. That's why they're wrong half the time, because they want to be right, so they jump out in front of stories and they do things. That's why I like this one, because it's just from NPR. Okay, NPR is not trying to sell you anything. They just want to be right. And this is thought out because the other guy involved with it is someone who just wants to be right. He's an academic. Let's look at it, though, and there's some information here that kind of blew my mind. You'll see why I reacted to this. What just happened, by the way, this is from Bobby Allen and Michelle Martin, June 30th, 2019. What just happened also occurred before the last 7 U.S. recessions. Reason to worry? Here's a picture of a guy, stock exchange, all that stuff. Signs are pointing to a coming U.S. recession, according to an economic indicator that has preceded every recession over the past 5 decades. It is known among economists as Wall Street traders as a yield curve inversion. Now, you guys know I talked about the yield curve. I said, hey, look out for this. Everybody's going to push this thing to the side because tariffs and trade wars, and all this other stuff. They'll push this to the side, but this is a crucial thing. I've said that in videos before. A yield curve inversion, and it refers to when long-term interest rates are paying out less than short-term interest rates. That never makes sense, right? You go get a CD for a year, they should pay you more than the CD for 2 months. A 1-month CD or a 6-month CD should never pay you more than a 1-year or 5-year does, but that's what's happening. Which tells you something, is that in the short term, something doesn't feel right to them. Okay? So it is known among economists, Wall Street traders, as a yield curve inversion. It refers to when long-term interest rates are paying out less than short-term interest rates. That curve has been flattening out and sloping down for more than a year, raising worries among some analysts that investors' long-term view of the market is not positive and that an economic downturn is looming. But on Sunday, an inauspicious milestone was achieved. The yield curve remained inverted for 3 months or an entire quarter, which has for half a century been a clear signal that the economy is heading for a recession in the next 9 to 18 months. According to Campbell Harvey, a Duke University finance professor who spoke to NPR on Sunday, his research in the mid-1980s first linked yield curve inversions to recessions. He's the one that figured it out. He has a direct interest in being right, which is good for you, because he's not trying to sell you anything. He's not trying to do anything except say to you, he figured something out and he believes from his experience it's right. Now, this is why he believes it, and this is why take it as a note of caution. That has been associated, I'm talking about the yield curve inversion lasting for a full quarter. That has been associated with predicting a recession for the last 7 recessions, Harvey said. From the 1960s, this indicator has been reliable in terms of foretelling a recession. And also importantly, and here's the kicker, it has not given any false signals yet. Now, he's an academic. Academics cannot say 100% accurate. Academics cannot say that because academics need to test something like 1,000 times and have to be right every time for them to say something even close to 100% of the time. And even then, they really couldn't say it because they consider the future. Anything could change. It could be on the millionth time it's wrong. So they'll say, within the 95% accurate with a 2% standard deviation, something like that. They'll have a standard deviation that they go off of. So the point is that he can't say 100%, but to me and you, that means it's been right 100% of the time so far. Okay? Still, and here's a chart of it. Actually, look at the chart. Look. It's like boom, and then a recession comes. Boom, and then a recession comes. Boom, and then a recession. It's just right. It's right. Look at this expansion duration, 120 months. We just hit 121 months of expansion, the new record. And look at the dive from that. So you see it. This thing's right. It's right, man. It's right. Look at the 10-year spread. I mean, something's not right? When you actually look at that picture, you're like 100% of the time, okay? Still, many economic forecasters do not see a recession on the horizon. For instance, Randall Quarles, the Federal Reserve's vice chairman for banking supervision, has said that the gap between short-term and long-term interest rates does not mean the U.S. is moving toward a recession. And then there is a sea of bright economic news setting the backdrop for the yield curve inversion hitting its 3-month mark. Unemployment is at a near historic low. The stock market is going strong, and the S&P 500 up 17% for the year. And while some economists say the pace of growth may be slowing, the consensus view is that a dramatic economic plunge is not on the horizon. When is it ever? Who in the world estimated a 20% drop last year? I remember I was like, dude, it's going to be Christmas time. I'm about to get my 20% like I do every year. And the fucking market destroyed. Absolutely destroyed. $5.9 trillion erased in 3 months. Nobody saw it coming. Everybody said it was reversing in the beginning. Oh, just dig with this volatility. You buy on the cheap. And then they were like, run. And then they were like, this could be the next thing. So it's just so full of shit. Everybody tries to act like they know. Nobody sees it coming. No one saw the Great Recession coming except geniuses. Like that guy, Big Short guy, And the other guys only found out because he misplaced information when he made a phone call, assuming he was talking to somebody else, right? And then there was a sea of bright, we already read that. But Harvey says no single economic predictor has the impressively prescient track record of the yield curve inversion. Yes, and this is what I love. Yes, the economy looks good right now, Harvey said. But the yield curve is about the future. It captures the expectations of the broad market in terms of what might happen in the future. Might a whole quarter of an inverted yield curve become a self-fulfilling prophecy? That's what they ask him. His answer? Perhaps. As we know, selling begets selling. Recessions can be talked into existence, but what we have to look at here is that this thing has been right 100% of the time. Nobody can see something coming. There's a lot of other things that don't seem right. For instance, did you know that actually over the last 18 months, the average return for most stocks is negative 5%? Negative 5%. 77 companies are driving the entire stock market rally. 77 companies. Look at and this is why people sometimes ask me, like, dude, you have you dedicate yourself to nothing? No, this is why I'm like, bing, bong, bing, 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 boom, boom. Take 5%, take 3%, take 7%, and just bouncing. I trust nothing. Because I don't believe it. I believe it to be fugazi. I believe it to be the algorithms and the only thing that will pay me because I trust nothing. And the reason why I trust nothing is because nothing makes sense right now. Let's look at this. Just 77 companies. Now, this is Market Watch, so they do have... But this is by Chris Matthews. The median global firm with less than $5 billion in market value is down roughly 5% on the year. If the global economy is weakening, why have global markets rallied so forcefully this year? This is a question you might ask yourself. Like, remember what the guy said? The stock market's doing great. That's a question investors would be wise to consider as evidence mounts of economic growth slowing in Asia, Europe, and the U.S., and as falling yields on government bonds indicate that at least bond investors are preparing themselves for tougher times ahead. Bond investors, the Scott Minards, right? The Bill Gross, the people that actually know the macroeconomic environment where there's trillions of dollars in bonds, they're just knowledgeable about macro stuff. That's a question, he said. Right? Ask yourself about the Asia, Europe, and the U.S., the falling yields. One reason for the discrepancy between the rise in broad indexes like the S&P 500 or the MSCI World Index, which have gained 19.5 and 16.7% respectively, and what appears to be a weakening global economy is that the advance is being powered by just a handful of mega-cap companies whose global scale and reach allow them to better handle rising trade tensions and weakening demand and keep their sales and profits rising. In a recent research note, Andrew Laphorn, head of quantitative research at Societe Generale, right, that's a very big, out of Europe, pointed out that within the nearly 1,700 constituents of the MSCI World Index, the mega cap group, which they got the market cap of above 100 billion, is powering ahead, whilst those in the sub 5 billion market cap range are still struggling to make back last year's losses. That's the reality. Small caps, most of the companies with 50 million up to like a billion are still nothing. They've gained nothing. There's still losses of like 10% on average. The more remarkable numbers are in the $100 billion portfolio represents just 77 companies. But 20%, that's it. There's only 77, but they represent 27% of the global market cap. He added, while there are more than 11,000 companies with market values of less than $1 billion, and the median company in that group has shed nearly 10% of its value so far this year. 10% of its value shed on 11,000 companies. Consider what he just said. Everybody's being fucking destroyed. They lost last year, the 20%. They lost another 10%. They're being eaten alive right before your eyes. It's like a slow, steady consumption of value that you don't even bear witness to because the S&P is up, the Dow is up. They keep you focused on this shit. It's fugazi. And this was shed nearly 10% of its value so far this year. And this is the problem. Our increasing focus on a few large cap indices populated by just a fraction of the world's companies is giving investors a false impression, Laphorn wrote. Corporates are struggling. This phenomenon whereby the large companies are outperforming small ones is present in the U.S., though not to be the same magnitude as globally. Stephen DeSanctis, equity strategist at Jefferies, wrote in a Wednesday research note, small cap U.S. stocks have trailed their larger cousins by 13% over the past year, as small companies have been unable to thwart off margin pressures as a result of rising costs in labor and materials amid an environment of slower economic growth. Nevertheless, U.S. small cap stocks are still largely producing positive gains, with 418 out of 600 companies in the S&P small cap 600 gaining ground so far this year, according to facts. But listen what he said. He's saying that 418 out of 600, but 11,000 companies are down 10%. So you see what I mean? He's taking. They keep doing that. They're taking the very small amount and go, well, but there's positives here, but there's positives there. But the vast majority, there's nothing positive. And so it becomes dramatically skewed, where we have this understanding of the way things are, but it's not really true. And then I was just looking and I said, what else is going on? Something kind of shocked me. I said, did you know the internet broke today? Facebook, Verizon, and more see major outages. I just found out about this, I found out about it yesterday. I was reading it, but my internet's out. It's been out all day. They're going to come out to my house tomorrow. They actually set it up for the 11th of July. I was like, whoa, that's so far away. They're like, we're so booked. This is Verizon. We're so booked. And then the lady ended up giving me an appointment tomorrow between 8 to 12. I was like, thank you very much. I was very kind to her, respectful. I said, I understand. And I think it made her change her mind. I don't know. She just did me a huge favor. But the point is to say, consider that for a minute. All this stuff, why you have these problems with, all these different economies, and there's no more like war right away. They go into digital battle. This one has surprised me. If this is like hackers from Iran or from North Korea or China, or all of them together ganging up to try to do damage. And these kind of things tend to happen when we want to put pressure on other people. We got sanctions on Iran. We're squeezing to death. Sanctions on North Korea. We go meet at the demilitarized zone. Trump meets him, Kim Jong-un, and then what ends up happening is he meets him, and then right after they're like leaving, America goes to the UN and is like, put more sanction pressure on him. So then North Korea is like, what the fuck? You guys were just here acting like you want to do stuff, and they release this news to their public, of course, on their media, which is totally government owned. And then of course they say how how horrible and disgraceful is America. They say this, but then they're trying to put more pressure on our throat, and then you have these outages, mass outages of like Instagram for hours, Twitter for hours, Facebook Cloudflare's destroyed. Like they got destroyed all by themselves. It went down again for a half an hour yesterday, and this time it was the company's own fault. We're still waiting on a full postmortem, but the short version is that a firewall regular expression rule targeting malicious JavaScript spiked the firewall CPU usage, crippling throughput and causing widespread HTTP 502 errors. Microsoft's Office 365 seems to have experienced a multi-hour partial outage yesterday. But man, destroyed. Our internet just got destroyed, and I'm still having problems today. Think about that. I consider these things because I'm like, well, there may be. It was like when the drop happened last year, I'm sure so many people were like, it's just us. No. When Trump is talking about tariffs, you know how much China had so much money in our stock market and we had so much in theirs? I wouldn't be surprised if they were like, we're pulling our money, whoosh, and then that just collapsed our shit. And then we're like, we're pulling it from you. And since we have more money, theirs collapsed even worse. And that's what happens when two gigantic economies decide we're yanking our money as best we can from you. You want to go to war here. And then whoosh. And then they're like, whoosh. And then you get collapses on both sides. And then both the governments have to try to prop up their economies. Boom. And it just becomes dynamic in nature. I mean, you get that volatility where they're fighting and you don't know if the money's coming back or how it's coming back. And then you hear these stories about these things that actually have been 100% accurate. And so I'm just very cautious. I understand there's going to be a Dow 30,000 potentially. I understand S&P may get to 31. I get that. But I have always had a problem with being something for too long. So if I stay bullish, by the time things turn bearish, I'll be the last one out. So I need to convince myself by staying up on the macro. I also, as you guys know, I never like this. See that black line right there? I don't like that. I don't like that our record is just like pink, pink. Because look what happened the last time. If you go to like the 1 year, look like this is, you go to the 5 year actually. This is our record. It's like record, boom, collapse. Then it's like you see the little line that's dragging. That's what you got to follow there. So it's like, look right here, boom, collapse. And then it's like record, look at our right, boom, collapse. It's like record, but boom. And now we're like record. Well, so far that's been a horrible sign. A record has been an omen. And I'm just concerned. I'm reading all this stuff and I have a major concern that there's so much propping up. And last but not least, I'll say this. Did you know that the buybacks are abysmal this year? There was $803 trillion worth of buybacks last year or something like that. Let's see if we can find it. I don't know. Sometimes you can find it. Stock buybacks. A week in 2019. Let's see. Slow. We'll do stock buybacks slow in 2019 and see if we can find it there. It could be a story somewhere. I remember a decline in share buy poses a hurdle for the stock market from the Wall Street Journal. When's this from? Yeah, July 2nd. Some companies are easing up on share repurchases this year, potentially removing a pillar of support. Hey, you know what? This is something I hate about Apple. I'll point this out right now. Watch this. Watch this. Here we go. So open an Apple News. Let's see what happens. Watch this. Open an Apple News. I want to read the story. Wait, what? But I was just, what? Decline in share poses hurdle. I have to pay you $9.99 a month to read this, Apple? No. I'll just go read it for free on Google, you dummy. Some companies are easing up on share repurchases this year, potentially removing a pillar of support for the stock market as executives contend with the consequences of trade tensions and slowing economic growth. Share repurchases contracted for the first time in 7 quarters, with the S&P 500 companies spending $205.8 billion to buy back in the first 3 months of the year, according to the latest S&P Dow Jones indices data. While still robust, that is down from a record $223 billion in the fourth quarter. And analysts say the contraction could continue as companies show signs of tightening their purse strings. Buybacks have been one of the biggest sources of equity demand throughout much of the bull market run, analysts say, with companies spending more than $800 billion last year alone on share repurchases, the most ever in a single year. Companies and investors often applaud share repurchases because they juice the per share earnings and can boost stock prices, but some skeptics contend buybacks add little value, only serving to prop up the stock market when valuations are relatively stretched and corporate earnings are weakening. There you go. So they normally do that, and if they're going to start squeezing and constricting that, tightening those purse strings, it could be problematic. So there's some stuff on the horizon in the macro environment. A lot of the stuff that you're not going to find if you're just focused on one stock. So you have people just focus on Cessin Bio. You have people just focus on this. I get that. You do your research, you fall in love with it. People just focused on Iovance. People just focus on Micron, Nvidia, your AMDs, your Apples, your General Electric's going to make a comeback. I get it. You love a company. You think they're different than everybody else. But this environment that is potentially building with $1.5 trillion in student debt, and the last fact I'll hit you with, and this is just, I'm constantly consuming data. Did you know that this is Jamie Dimon, CEO of Chase Bank, just said this, and I was like, what the fuck? What a fact. For every $1.5 trillion in student debt, 500% increase in like 5 years. Like, just unimaginable, like last decade. Unimaginable amount, just doubling and doubling and doubling. And he said for every $1,000 increase for student debt per household, mortgage loan applications drop 1.8%. 1.8. $10,000 rise? It's over 11%. Consider that. Consider the damage that would do. Consider how atrocious of a bubble is building. I mean, you wonder why people are trying to sell that as Democratic candidates, trying to sell that as a talking point. If it's something they're going to do, which is bullshit. But the point is, and nobody will do it, but the point is this. We have to consider that. You cannot just keep going for, you know how I always said Bollinger Bands, the top of the chart. Think of all the market as a gigantic chart. Everything's a chart. Risk versus reward. Consider all of that. The big fucking picture, the long-term picture. You're like this. Your Bollinger Bands are up here. Candles going up. Your 20-day, your EMAs, all the lines passing through. You have all that stuff. And then you have other signals like RSI, to tell you that something's heating up too much. Williams percent R. If you're MACD, you have all these things, all these technicals that could break down. Well, some of them are breaking down. And some of them are sending signals like breaking out of the Bollinger Bands. Because the market's everything is up. With everything expensive. With a lot going against it. With a lot of money coming out of the market in the form of tariffs. In the form of student debt. In the form of people becoming scared so they take more. It's an easy way to scare people out of the market because if people feel like they're going to lose money anyways, what do they want to do? Take it out and spend it. That's what almost has to happen, right? That's the good thing. If we all just get scared out of the market, it collapses, but we take the money and then what do? We spend it. And then what does it do? Inflates earnings. That's a good thing. So almost the best thing that could happen is a good correction. Even better than the last time. Maybe a little bit longer so it's not a direct drop, but something like this, where it's kind of like, everybody getting some time to get out. That'd be the best way possible. So all I'm saying is I'm watching that. I'm watching it. I'm never going to be able to tell you. No one can time it. But it's something I feel like we should all be watching. I'm so sorry this one was long, but it was a lot of information, and it was a different pace than the usual. Look at this stock. Look at the EMA. Look at the SMA. I was pounding that shit. It gets old because there's so much more stuff. There's just so much more to be looking at than just a chart, than a single stock. None of that survives. None of it. Everything will bleed red. If the big dogs bleed red, everything bleeds red. So I hope you guys found value in this video, and I hope you're doing that. Keeping an eye on the macro stuff, remembering not to stay one way or the other, and trying to be better than me or you were yesterday, and then to remember to buy the Jordans, buy the cologne, go take the vacation, spend some money. You actually help the economy more when you don't save. You actually help investments more when you sell their stock to go buy the stuff they sell. You help it more. It's crazy, but it's true. I mean, think about it. If you own a stock and all you do is ever save, who the fuck is spending their money, right? You need to spend some. So take some out and spend that money a little bit. Enjoy it while you got it. All right? Happy 4th. Love you guys. Peace.